Worldwide corporations attract trillions of dollars from millions of investors. These investors are owners or stockholders of corporations, and as such have certain rights.
The rights of a shareholder are several. There are votes for certain things like the directors of the company. Any other business that needs to be voted on by the shareholders will happen during that annual meeting. Some of the larger corporations out in the public today obviously pay a dividend, usually a dividend yield of between 2 and maybe 4%. And obviously you as a shareholder will get your percentage of that. In addition, when you are a shareholder and the company does do another offering or raises capital for some other investments, you have first crack at getting a percentage of that offering, so that you keep the same percentage of the company that you own.
Stockholders control a corporation indirectly by electing the board of directors.
The highest level of corporate governance is the board of directors, and is a group that meets probably 10 to 12 times a year, and their principal charter is to provide some oversight to management, a fiduciary responsibility of assessing on behalf of the share owners the diligence with which management is executing its mission to create wealth and grow the business, and to provide advice and counsel to management as it goes about that business. Most, I would say, boards engage in strategic issues, not in monthly reviews of budgets and operational performance. The board then awards to the chairman and the management team, the senior management team of the corporation, its responsibility and its authority to act again on behalf of the owners, the share owners, in their roles of the day-to-day management of the business.
Ultimately, investors vote on how effectively a corporation is managed by bidding up or driving down the price of its existing stock and any new stock it may want to issue. Shareholders are not only the owners of corporations. The stock they purchase is a major source of a company's capital. There are two major categories of stock.
In our equity section, we have common stock and we have preferred stock. Common stock controls the corporation through this right to vote. Typically, preferred stock does not have a right to vote. When you think of the word preferred, you automatically think, well, they must be better in some way. Well, not necessarily better, but just different. I think the term preferred comes from when we think about dividends. The preferred stockholder is entitled to a set amount on their stock before the common stockholder is entitled to anything out of the declared dividend pool. This does not necessarily mean preferred stock is going to get more dividends per share. It just means their allocations out of the dividend pool is made first. Preferred stock has other features. It could be cumulative. If it is cumulative, that means that if the board of directors determines that they would like to pass dividends this year, the preferred stockholder is owed this preferred amount as we move on into future years. If there is a dividend declared but it's not sufficient to pay the preferred stockholder their preferred amount, the insufficient amount also becomes arrears, moving into an amount owed in future years. Common stockholders do not have any of these rights. Sometimes preferred stock carries a convertibility feature, which means that at a given point in the future, the preferred stockholder may choose to convert their shares of preferred stock to common stock. Sometimes we associate with preferred stock a call feature. It is termed callable preferred stock. Now, this is really an advantage for the corporation. They can issue the preferred stock to obtain the necessary capitalization. Then at a future date, when they no longer need this necessary capitalization, they can buy back the preferred stock at their option, and thereby in future years increase the available dividends for the common stockholders.
Corporate equity is shown in the equity section of the balance sheet, and changes in equity are detailed in the statement of stockholders' equity. In corporate accounting, legal requirements require careful identification of the sources and amounts of corporate equity. For corporations, contributed capital represents owner investments, and retained earnings represents net income and loss over the years, less dividends to stockholders. Owner investments increase assets and owner's equity. For the corporation, this means issuing stock to investors and receiving an asset, most typically cash. We need to know a number of things before recording a sale of stock. First, what is the class of stock? Common or preferred? 2. Does the stock have a par or stated value? 3. How many shares are being sold? And 4. How much is the stock being sold for? Let's assume a corporation is selling 1,000 shares of its common stock and is not required by state law to set a minimum price or par value per share. The selling price is $10 per share. Total cash received is $10,000. What if the 1,000 shares sold for $10 each also happen to have a par value of $10 per share? Understand that par value and market value are not the same thing. The sales price and par per share value are the same here, just for illustration purposes. Notice the entry is the same as before, but the $10 par value is noted. Now, let's sell the same 1,000 $10 par shares for $15 each. Cash goes up $15,000. The common stock account goes up $10,000, as in the previous entry. Where does the remaining $5,000 go? Well, it is an owner investment, so we need an equity account. That account is called contributed capital in excess of par value, common stock. A real mouthful, but it carefully establishes the source of capital, which is a legal requirement when accounting for corporations. No par stock may be assigned a stated value by a corporation's board of directors. As with par value, the stated value becomes a legal minimum sales price for the stock. Let's say a corporation sells 1,000 shares of no par common stock, to which the board of directors has assigned a $10 stated value. Once again, the selling price is $15 per share. Notice that this entry is very similar to the previous one. The only differences are including a no par designation for the common stock account as well as the contributed capital account. Stock is not always issued for cash. The basics remain the same. Assets increase, equity increases. Obviously, the specific asset must be identified, such as land or machinery. The stock issued must be recorded, but at what dollar amount? Fair market value is used. The fair market value of the stock is used if that is readily available, which would be the case for stock trading on an exchange. Otherwise, the fair market value of the asset is used. The number of shares and the existence of par or stated value must be considered before the entry is made. Recording preferred stock is exactly the same as with par value common stock, except that preferred rather than common is used in the account titles. The sale of 1,000 shares of $50 par preferred stock for $75 per share would increase cash by $75,000. The preferred stock account by $50,000, with the remainder going to contributed capital in excess of par value preferred stock. The price of a corporation stock is determined by the stock market. Book value per share is another measure of stock value. Book value is sometimes used to approximate how much each share of outstanding stock might realize in cash if the corporation was liquidated. Calculating book value per share is straightforward, especially if there are only common stock shares outstanding. Simply divide total stockholders' equity by the number of common stock shares outstanding. Total stockholders' equity must be allocated where preferred and common stock outstanding exist. First, allocate part of stockholders' equity to the preferred stock. Check to see if the preferred has a call price and if it has a cumulative feature with dividends in arrears. If this is the case, then the equity allocated to the preferred stock equals the number of shares of preferred stock outstanding times the call value, plus the amount of cumulative dividends in arrears. Subtract the preferred equity from total stockholders' equity to get the allocation for common stock. Divide this amount by the number of common stock shares outstanding. The result is book value per share of common stock. Though book value per share has some usefulness, it also has limitations.
The problem with book value, which gets reported by a lot of companies, is basically book value is historical cost. And as circumstances change and prices for items change over time, that's not reflected on the balance sheet. So when you're looking at book value, you're looking at basically a snapshot of what the net assets are of the business if you were to accumulate all of the purchases and expenditures that they've made over time. And it's really not meaningful to the current market price of the stock. The only thing that's really used for is that certain investors use it as a general guide as far as what the valuation of a certain company's stock price should be.